This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Hello, this is Hall Martin with Investor Connect. Today I'm here with Nick Iovacchini of KettleSpace. Nick, thank you for joining us.
Thanks for having me.
So what was your background before joining KettleSpace? What did you do before this?
So I've been an entrepreneur going at different angles of consumer my entire career. I was a former college baseball player, and after graduating college, I started my first company. It was actually a licensed sports accessories company where we used to cut up baseballs to sort of kill time and wear the seams around as necklaces or bracelets. And that led to the first company that I started called Gameware, where we took the idea of wearing parts of the ball or the game and putting it together with licensing logos from popular sports teams. We got a major league license, an NFL license, NBA license, NHL license, you name it. And we ended up taking that business from two guys in the basement to selling more than 10 million products together globally. And after that, I had an exit, had a little bit of money in my pocket, and I got recruited to work in the restaurant industry and be part of a restaurant that was launching in New York City. And despite plenty of advice from well-intended people, I decided that that was something that I was interested in doing without kind of really having ever done it or understanding the inherent challenges of it. But I began as what was supposed to be a small investor and an advisor to a restaurant project in Manhattan. One thing led to the next, and I became a lead investor and the leader of a restaurant that's called Distilled. It's still going. It's in its 8th year. And in doing that, I learned very quickly why I got all the concerns and guidance against getting into it, because what I realized is it's such an incredibly difficult business model for many, many reasons, which I can go deep on. But long and short of it is we figured out how to survive it in doing so. Figured out there aren't a ton of solutions out there that fundamentally improve a business model that's so challenged. And I got connected through a mentor of mine with my now co-founder, Dan, who was coming from WeWork, and he had the initial idea for KettleSpace, and this big vision was his. So we tried it out at my restaurant and saw it working and decided to get involved from there.
So what's the idea behind this work in the workspace sector that you're doing?
Yeah, so the idea is that we're solving kind of a two-sided problem statement. We have millions of remote workers who have really nowhere to go, and loneliness has become more and more of an epidemic. Working from coffee shops and places like Starbucks or Panera, really not a great productive work experience. Traditional co-working is now here to stay, but it's prohibitively expensive for a lot of people. And then we have so many of us work from home, but that can be distracting or isolating or really not super productive for many folks. And then between technology and social media, a lot of us are now more than ever, quote, more connected than ever, but we're also more disconnected than ever. And that's leading to feelings of isolation and loneliness for a lot of people. So on the other hand, we have restaurants and hotels and cafes that are sitting empty or facing squatters during prime working hours that are already built, already operating, beautiful, bright spaces located in prime retail areas that are effectively underutilized so much of the time. So what we're doing is we're kind of marrying those two groups together, and we're building an enabling platform solution, taking this underutilized hospitality space and transforming it into a network of on-demand workspaces, which we provide to our members for that same $5 a day cost of a latte. For $100 a month, they can get unlimited access to all the spaces in our network. The Wi-Fi is going to work. You're going to have access to a power outlet. You'll be in a professional environment. You can leave your stuff when you go to the bathroom. You can get discounts on food and beverage. You can attend an event, get educated, make connections, make friends, collaborate, kind of all the stuff that goes along in a productive working environment with other people at a fraction of the cost of traditional co-working. And then really a big part of our thesis below that is that people are lonely and that we're trying to make a positive impact in the world and harness some of the research that exists in behavioral science to really facilitate meaningful below the surface connection between our members.
So, what's your advice for people investing in this workspace sector? What do you tell them to do before they write that first check?
Well, get educated on the sector in general. I mean, if you look at where we sit, on the one hand, you have traditional co-working, which has really existed for a long time. Regis was kind of the pioneer of bringing traditional co-working to market, and then WeWork had a version of that. But there are capital inefficiencies in the WeWork model that are now exposed over the last few months. But for a long time, we're kind of swept under the rug. And then on the other hand, you have kind of free workspace, which isn't usually free. It usually comes with the purchase of something like a cup of coffee or a sandwich or something like that. And sort of the limitations and ambiguity and challenges of working consistently and expecting a professional outcome in those environments. So we sit somewhere in the middle, and I think it's important for an investor looking at an investment in this space to kind of understand the pros and cons and the markets that each of that spectrum of the competitive landscape is serving. And we believe we're attacking a massively underserved segment because traditional co-working is really thriving and it's everywhere in terms of shared office space. But there's so many folks that are working from home that really don't have a viable solution that's flexible and affordable.
Great. So, let's talk about the state of investing in this sector. Of course, it's changing very rapidly, but how do you see the industry evolving today? What's the growth rate and who's playing in it?
Yeah, well, the answer today is quite different than the answer was 6 months ago. 6 months ago, we were representing kind of traditional co-working was poised for an IPO, which had a lot of kind of lead up and anticipation, but many investors are probably aware that IPO kind of fell apart at the 1 yard line. And a lot of the reasons behind that are attributed to not really minding unit economics and having a capital efficient business underneath the hood. So that's something that we've been very intentional about, not only putting in our pitch deck as something we could achieve, but over the last year, really focusing on validating that we can do that. But the industry is here to stay. The gig economy is growing at a rate that will make it the largest segment of the US workforce within the next decade. So freelancers will be the majority of American workers in 10 years. And then you've also got this other massive wave of corporate flexible workers, and long sort of gone are the days of most people showing up to work for 60 hours a week to work from an office. And many people are now in an environment where they can work some from the office and then some from work from home. But again, work from home isn't necessarily kind of productive and really a high quality experience for most people from an engagement standpoint. So those are the massive waves that we're riding in our business and co-working in general. And it's only going to continue to grow in terms of demand.
So, in such a high growth space, what are the challenges in making that business model work? What do you see as the fundamental component you have to get right?
First and foremost, you got to get your unit economics right, because as much as we want all be a technology company and fancy ourselves completely digital, the reality of workspace is you exist in a physical environment and it's a brick and mortar type of business. So if your business model isn't built for viable, strong unit economics, at some point, whether it's now or 2 years or 10 years from now, you'll have to answer to those unit economics. So that's one of the challenges, is thinking creatively about a way to have scalable and compelling unit economics. And for us, that's on the back of really having an asset light starting point. We are completely utilizing the operational and the fixed assets that are in place with our partners. And we can go very fast in terms of opening a new location. And then on top of that, we've worked hard to really demonstrate strong four-wall gross margins as well as across our portfolio. The other piece, which is challenging for us, is utilizing technology to stitch together a digital world, a physical world, a workspace world, and a world of community and connections. And all of those things are kind of necessary to have a really compelling offering in our space. But there's a good bit of coordination and alignment that really needs to happen in a frictionless and accretive way for it all to work kind of in a really compelling, virtuous cycle sort of fashion.
And how did you pick that business model the way you do it that way? What led you in that direction?
Well, my co-founder, Dan, this was his idea. And when he was working at WeWork, the light bulb kind of went off for him as he was moving around the country, kind of underwriting these large CapEx intensive deals. And he had been working in hotels and restaurants and kind of had the epiphany that like, this is as asset light as it gets. These assets are sitting here. They're just not being used. So a big part of the initial thinking really came from utilizing excess capacity in existing infrastructure. And then one of the add-ons that we've had as we've been in market was also the idea of utilizing the operational and marketing assets that our partners have as well. So in addition to not having to build out a space, we also don't need to have a full-time employee in every location. We sort of share some of those operational duties with our partners.
And so what's next for KettleSpace? Which direction are you going to take this?
So we're really focused right now on building out our technology. Our mobile app is releasing in March, which is exciting, V1. We have a strong presence in New York now with 16 locations. We plan on continuing to invest in the New York market as we grow and continue to improve the value and that our product delivers to both our members and our partners. We will be expanding into other markets.
That's great. And what kind of markets do you think you would go after? High dense urban settings, or would the model work everywhere?
We believe the model will work everywhere. And one of the next cities we go into will be inherently different than New York City, just so we can kind of demonstrate that the model isn't only for elite, dense urban markets. So that's one of the boxes we'd like to check with near-term expansion.
Well, that's great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
Let's see. Well, we could talk about our growth. We've had pretty solid growth. All if that's
sure. Tell us about the growth story you have so far.
Sure. So we've grown 4x over the last 18 months. We've really been focused on both B2C and an emerging B2B opportunity. We have ARR north of $1 million at this point and made product improvements to improve retention. The next 2020 is really going to be focused on building out the technology and the marketing engine, along with the branding refresh that's coming to support continued growth.
Well, who do you see as your main competitor at this point? Of course, there's many players in the co-working space, but are there any particular areas you think you're coming up against?
Yeah, our primary competitors are kind of listing platform models where their folks are taking excess capacity at co-working spaces and sort of utilizing a space, our platform, to match users up with underutilized space. And while that does have some advantages in terms of being incredibly asset light, it also, we believe, kind of misses the opportunity to really build a connection with members and our business and member to member. And we found that even though that on the surface, this is really about affordability and space and productivity, just below the surface, there's a very strong current of people really wanting to make friends and make connections. And that's coming through loud and clear through our user research, as well as through a lot of the scientific research that exists on a national scale. So we think we stack up pretty well against those competitors with that respect.
Well, great. Well, how best for listeners to get back in touch with you?
I'm Nick at KettleSpace.com.
Great. We'll put that in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Cool. Thanks very much, Hal.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Halti Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinions of Investor Connect. This podcast is for informational purposes only and should not be relied upon for the basis of investment decisions.